Articles throwing caution to the real estate market in Singapore due to the war on trade tariffs, layoffs in certain sectors, and risk of impending cooling measures are juxtaposed against the consistently high sell-out rates of recent new launches, positive news such as HDB Upgraders switching to private properties in 2024, increase in number of private property ownership, as well as more developers coming back into the market with aggressive bids such as the one at Bayshore, hitting a new high for the OCR at 1388 PSF per plot ratio, together with a whopping 8 bids for this plot.
With all these confusing headlines, where exactly is the market headed to in the next couple of years? Will it be a positive continued growth, or is the market already overheated and there will be a crash next? Today, STL seeks to explain and unpack where the property market is headed in the next couple of years.
Before we begin, let's take a look at how the market has trended historically. If you look at the private property price index, as expected, there are rises and drops in the price index, with the Asian financial crisis, dot-com bust, SARS, and global financial crisis seeing sharp dips in property prices. However, since the introduction of the first major set of cooling measures in 2013 in response to an overheated market, this cooled the market down over an extended period of 15 quarters. Henceforth, we haven't seen the sharp dips we used to see in the past. This is primarily because there used to be a lot more speculative buying in the past where there were no restrictions such as seller stamp duty, TDSR, LTV, and people could buy and sell the same unit in just a matter of 3 months. Based on MAS statistics, speculatory buying was as high as 31% of all transactions in 1995. Households were also way over leveraged given there were no restrictions of how much your income could be used to pay off your loan. So when the crisis hit, households couldn't pay off their loans, banks foreclosed their units, and that's why you used to hear a lot of bank auctions, mortgagee sales, and bank sales in the past. With massive selling, and banks were only incentivized to cover their costs quickly, that's what led to a sharp downward price movement. However, in today's market, with TDSR of 55%, LTV of 75%, ABSD and SSD rates in place, it's no longer easy or no longer possible for anyone to be over-leveraged or holding multiple properties anymore. Holding power became stronger, and that's why even during COVID, where there were 2 quarters of technical recessions in 2020, the property market barely dropped by only 1% and subsequently recovered.
While we were just hit with COVID in 2020, there was a bit of a shock to the market. Transaction volumes dropped, however, property prices still grew by a modest 2.2%. Subsequently, in 2021 and 2022, the prices grew significantly by plus 10% and plus 8.4%. This was mainly due to a couple of factors, such as construction delay by HDB BTO, which led to people to move straight into the private resale market, quantitative easing around the world that led to pumping of liquidity into the market, together with low interest rates as well as work from home culture, leading to people to want to own their own spaces. Singapore was also seen as an attractive safe haven investment from foreigners with the way we handled the COVID versus other countries, just to name a few. Growth in 2023 and 2024 dropped to 6.6% and 3.9% respectively because of the increase in interest rates to battle inflation due to over quantitative easing in the previous COVID years. Not just the interest rates increase, banks stress test interest rate to calculate how much one can loan also increased to 4.7% interest, reducing people's budgets by as much as 8.7%, which led to some to postpone their property purchases. So how will the property market fare in the next couple of years?
Let's first take a look at supply, which is more inelastic in nature. If we take a look at the supply chart for the total uncompleted unsold units, we currently have 19,940 units still available, which is under our 10-year average of 24,000. We've been in an undersupply environment for quite an extended period of time since 2021. So why is this so? Let's take a look at what this supply consists of. Developers replenish their land banks via two avenues. One would be the en bloc sales of old condominiums and the other through government land sales. So the en bloc market has been pretty dead in the last few years due to a consistent price gap between what developers would pay and what the owners want. Developers have high ABSD rate of almost 40% from 2021, higher construction costs, interest costs as well. And owners also aim for a higher price due to their increasing replacement and ABSD costs for second purchase of properties. En bloc deals also tend to be trickier as they require additional costs on renewal for lease, tearing down of the old building, to excavate the land, which leads to a general preference for the GLS land rather than the en bloc land. So our government's release of GLS sites has increased over the years. After realization that the en bloc market was not really picking up, the government has to be very careful to balance oversupply in the market. So they only increased their quantity to 9 to 10,000 over the past 2 years, so as not to create too much supply in the market. However, GLS land will require about 1.5 to 2 years before they get released for sale, so this will have a lagged impact on the market. This is also not really sufficient to meet the growing demand, given how dead the en bloc market has been as well.
If we look at the supply of resale properties, we can actually generally split them into a few different groups. One would be TOP supply of new launch developments. That means they just collected the keys. Another would be MOP of ECs. And the last would then be the general resale supply that is listed on online for sale. So TOP supply in the next 2 years will actually be low at below 10K units. If we look at this chart from URA, you actually see the dark red portion of these bar charts are the private residential units we should focus on, because ECs generally need to observe a 5-year MOP before they are sold in the resale market. So this number is actually quite low up until beyond 2028. The number of ECs hitting MOP and can be sold in the resale market in the next 5 years has also dropped to only 2 developments due to the COVID-19 effect. The general volume of resale transactions has also dropped compared to the past, with many of the older generation not being able to buy and sell properties because they own multiple properties before ABSD on second and subsequent properties were introduced. So it doesn't really make sense for them to sell all their properties just to buy one property in order to avoid ABSD, because they could continue to collect rental from all these resale properties that they own. The resale condo transactions actually only take up 4% of total existing condos in Singapore, whereas in the past, between 2009 to 2012, before the ABSD rulings on second and subsequent properties were introduced, it was on average around 6.9%. So there's already this group of sellers who actually have left the market and are not selling their properties. Now let's take a look at demand. Who are all these buyers who are buying private property, and where is this demand coming from?
Let me start off by sharing an interesting trend that historically 80% of households live in HDB while 20% stay in condo and landed properties. This percentage has been gradually changing. Right now, the percentage stands at 77% in HDBs and 23% in private properties. So we can first rule foreigners and companies out of the equation, because with ABSD rates at 60%, the current percentage of contribution from foreigners and companies comprise only about 2% of the market. PR ownership takes up 10%, while the largest increase has been from Singaporeans, from 73% in 2010 to 88% in 2024.
So where are these Singaporean buyers coming from? Fundamentally and historically, a large of these buyers are HDB upgraders who have profited from their BTOs, and with their profits from the subsidized housing, it easily forms their down payment for private purchases. Historically, 46% of yearly private property transactions actually come from HDB upgraders from this chart over here. As long as government continues to fund subsidies to the public housing market, this could continue to also fuel private property housing demand from HDB upgraders. However, even though this news article shared that more HDB upgraders are making the move in 2024 compared to the previous year, the percentage of HDB upgraders buying private property has actually dropped over the past few years, with only 30% of private property transactions contributed by HDB upgraders in 2024. This is likely due to the still increasing HDB resale prices, the high interest rate environment up until Q3 of last year, causing many to potentially delay their upgrading plans. The 2024 to 2026 period also experienced some supply tightness of MOP flats due to COVID, but the supply will increase to above 20K from 2027 onwards.
So now there are two main risks to the HDB sector which could cause a potential spillover effect onto the private property market in the next few years. Like we mentioned in the previous video on our 2025 outlook, as HDB resale prices continue to climb, the line between buying a resale HDB and a private resale condo starts to blur. HDB prices can't climb so much faster than private prices consistently, or there will start to be a greater and greater shift of demand from HDB resale directly into the private property market, as we are already currently seeing right now. This could mean that there could be an inflection point over the next few years. And another risk could be cooling measures as well. If significant cooling measures were to be introduced to limit borrowing capabilities or LTVs, making it harder for people to purchase expensive HDBs, or a significant clawback of resale subsidies upon sale, this could reduce the demand and potentially prices of HDB flats.
Logically speaking, if the HDB market doesn't do well, then shouldn't that also mean that the private property market will not do well? Here, I will actually want to point out an anomaly that happened around end 2017 to 2020, where you actually see that while HDB prices actually continued to drop, private property prices started recovering from 2017 on the way to 2020 during the same period of time. Back then, HDB prices dropped for a period of a prolonged 4 years, and there was a jump in the number of MOP units from a historical average of around 10K or under to 20K, 12K, 15K from 2016 to 18, and a sudden jump again to 30K and 25K MOP units in 2019 and 2020. These HDB upgraders started to realize that they better sell before the supply gets too much and before prices fall even further, and this fueled demand to upgrade into the private property market. As you can see from this graph between 2018 to 2020, the proportion of HDB upgraders in private property market actually increased. So knowing that HDB MOP supply is going to increase to above 20K units from 2027 onwards, and if HDB prices were to start to drop due to the risk factors that we mentioned just now, could this potentially lead to a similar situation that we saw in 2017 to 2020, where HDB prices dropped while private property prices increased? Furthermore, as we can see, the dependency on HDB upgraders to fuel the market may have actually started to drop over the years, as many more start to make the leap straight into private property market, given the more restrictive rulings in BTO market, higher resale prices, and increased affordability. Taking one step back, let's take a look at the fundamental firepower in the private property market. A private property is funded by a mixture of cash, CPF, which forms your down payment, as well as your loan. So let's take a look at the cash component first. Here's a look at the household balance sheets in Singapore, and in particular, just zooming straight into household currency and deposit holdings, which I would term as liquid cash, and liabilities, which include both personal loans as well as mortgage loans. In today's market, Singaporeans are actually very cash rich. In the past, before 2013, if you look at this graph, the amount of liabilities is about the same level or sometimes even higher than the household liquid cash. While households still had their CPF holdings to rely on, if there were any shocks to the market, it could cause fear of ability to pay back their loans. However, today's liquid cash has actually risen so much so, even if households were to pay off all their liabilities, they would still have $279 billion worth of liquid cash left over. In fact, the current average loan-to-value ratio of properties is just 41%.
So where does all this cash come from? Some sources will include increases in household income, which we'll explore more in the loan portion, government's quantitative easing stance during COVID, which pumped in quite a bit of liquidity into the market, people making money from other investments, as well as generational wealth transfer. So I just want to cover the last point a little with regards to purchasing properties. We are starting to see the profile of buyers in the market shifting to younger ones, with the 26 to 35 years old growing from just 9% in 2015 to 35%, while those 45 to 55 years old have shrunk from 33% to 17%. Remember we mentioned earlier on how many of the older generation hold properties and can no longer buy and sell due to the higher ABSD rates, so they are just holding on to their existing properties. This data on the growing trend of younger buyers is also congruent with the observation we've observed in the market from among our clients, as well that more and more of the older generation who don't want to adjust their portfolios anymore are co-investing with their kids, pumping in cash and money through their kids' names to continue investing in the market. In fact, during the recent higher interest rate environment, many Singaporeans didn't want to pay the higher mortgage interest costs and put lots of funds in their fixed deposits. Now fixed D rates have come off, many of them have taken them out and reallocated them into the private property market.
Moving on to the liabilities portion, let's just take a look at how Singaporeans' household income has grown over the years to see how much people can borrow in today's market. The chart here shows that the percentage of households earning more than 20k has increased from just 12% in 2015 to as much as 20% in 2024, which means that 1 in 5 households are at the highest income bracket of 20k or more. Diving into greater detail, let's take a look at the average household income by deciles. Given that it's mainly the 7th to 10th decile that have a higher percentage living in condos, I will just focus on these deciles. Remember, each decile represents 146k households. Just for perspective, there are currently 259k households staying in private non-landed property and 328k if we include landed property as well. We have adjusted the incomes to be without employer CPF contribution and also calculated what was the corresponding budget based on TDSR, 30-year tenure, as well as 4% interest rates. At the 7th decile, the income is 14k and the budget is 2.2 million. At the 8th decile, the income is 17k and the budget is 2.6 million. The 9th decile, 20k, budget 3.18 million. And the 10th decile, 29k, budget 4.5 million. As you can see, there have been actually big jumps in the growth of income in the past 3 years, as much as about 17 to 18% jump. The budgets are very, very decent. In fact, households from the 8th decile onward is more than able to cover the total number of households dwelling in private properties, and their budget is at a sweet spot pricing of $2.6 million onwards. Maybe that's also the reason why 3 bedrooms at the mid-2 million mark are still able to be accepted, and there are more and more 3-bedroom premiums selling at 3 million and above mark. Hence, Singaporeans' ability to borrow has been strongly supported by these high household incomes. If I were to take an average of 3% growth of a conservative estimate and to just forecast into the future of 2025 to 2028, we see that the budgets from 7th decile onwards, even in the future, will be very, very decent. So their budgets already increased to about 2.5 million, right, just in 2028 alone.
So a lot of these people are not necessarily HDB upgraders. They could be condo owners upgrading from one private property to the next, moving from OCR to RCR to finally CCR, or first-timers entering into the market. So when we look at both the loan and the cash aspect, we can see that Singaporeans have a lot of firepower to purchase private property in Singapore. We're not talking about your speculators or investors. In fact, the percentage of non-owner occupied properties has stayed relatively constant at around 10 to 11% over the years. There are also many households that can well afford private property but have not purchased yet. Furthermore, with Singapore's aging population, Singapore has no choice but to take in new citizens and PRs every year. From the demand perspective, we definitely see it holding well into the next 5 years, and in fact, we do expect prices to rise on average faster than what it did in the last 2 years. And if that inflection point for HDB really happens, more HDB upgraders might come back into the market from 2028 onwards. Given the generally prolonged lower supply in the market, this will all point to the likelihood that prices will rise.
Even with trade war and the potential reversal of interest rate cuts as well as the potential for additional cooling measures, this will only serve to slow down the growth of the property market because unfortunately the firepower in the market is still very strong. And we actually see more and more people paying pure cash for their properties within the market itself.
So thank you very much for staying to the end of this video. If you like this content, please help us by liking and subscribing to our channel. If you need help in making an assessment of your current property portfolio, please feel free to contact us in the WhatsApp links below.
Thank you and goodbye.
Bye.